I think the question is not why they're falling, but how they got that high in the first place, right?
That's a good point.
So there is a fair value, or there's a correct valuation, and we were marching to that on the way up. We went through that for over a year, and we needed a catalyst to reverse that direction, because if you don't have a catalyst, you've got momentum, and the stocks just get more and more expensive. And I think that catalyst was the midterm elections, where I think any prospect of further tax cuts is off the table. And if you don't have further tax cuts, how do you support high valuations? And the highest valuations was in the tech stocks. So they reverse, right? Now, as they reverse, they'll probably reach fair value somewhere around here, or maybe another 5–10% down. But they're not going to stop falling until there's a catalyst to reverse that.
I would like to ask you what would that catalyst be, but I suppose it's anyone's guess at this stage.
If I knew what that catalyst was, I'd be writing options, right?
So it sounds to me that you're saying this is really looking at the FANGs coming back down to normal, back down to earth here. Can the same be said of what is happening in the tech space in Asia, or do you still see value out there?
There is value in Asia already, but I think the trigger for a turnaround, or the catalyst, will be something that happens in the US, because the US market is the largest one. It leads, it drags everyone along, or it pulls everyone along.
Yes, and that's part of what we're seeing with Apple too, because the demand for its suppliers is so pronounced here in Asia. Are you still saying I wouldn't touch this sector? It is too risky then?
Well, I wouldn't have touched it a few months ago, right, or a year ago, and I would have given up a lot of profits. But that's the way these markets behave. There's momentum, and they go through their fair value on the way up and on the way down.
Let's talk about areas that you would touch at the moment. What does look compelling to you as an investment here in Asia?
On a relative basis, you can play the Asian trade, the growing middle class, through luxuries, for example. It's a very resilient sector. It always has been. It's price inelastic. It's not going to be subject to trade war, because you're not going to slap tariffs on something that's not a staple. And demand continues to march upwards.
They may not be exposed to tariffs, but what about the weakness in the Chinese currency? I mean, a few luxury players have said they are concerned about that impact going forward. So far, what we've seen from the European luxury giants, demand in China is holding up. But could a change in consumer appetite be a real sore point later on?
Yes, but I think there are mitigating factors. The currency is one thing, but if you look at the pricing policy of many of the European luxury companies, they're equalizing prices internationally. So it doesn't matter whether you buy in Europe or in China or online, for that matter. That arbitrage is gone, and so the demand is more real.
Hey everybody, it's Hadley Gamble from our new CNBC Middle East Bureau in Abu Dhabi. Thanks for stopping by. Now, to watch more, you can try one of the videos that just popped up on your screen. And don't forget to subscribe.